Hi everyone. So in this work example, I'm going to illustrate how to perform optimization for financial models. And the financial problems actually come in all different shapes and sizes. So unlike blending problems or product mix problems or scheduling problems, you will see a sort of similar pattern. Financial problems have any have have any number of patterns, and they're all very different. And the optimization, of course, goes in a very similar way. But the key there is also always in financial problems is to really understand what a problem is. And when you build a model, you have to identify the objective function, you have to identify all the right decision variables and the constraints and so on. So I can't tell you that I can give you a representative financial problems for optimization. But I picked this one because because it requires a little bit of data manipulation, which is very common in any type of financial problems. And the optimization itself is pretty simple, but hopefully you'll see how, in general, how you approach a financial problem. So this is problem number 95 in chapter 14. So that's on page 712. So please open up the file P14 underscore 95. It may look a little different on your computer. I simply changed the column width and nothing else. So this file has the data of average of the return on annual return for the three major indices from year 1970 to 2014. So the three indices are S&P 500, which represents which includes all the 500 largest market cap stock in the U.S. Um, so S&P 500 usually is a good representation of the stock market. The second one is a 3 month Treasury bill, which usually represents the risk-free investment. So when you take finance, for instance, the risk-free investment when you calculate beta, use risk-free investments. You usually use a 3 month Treasury bill. And then the third one is a 10-year Treasury bond, which is a good representative index for government issued securities or fixed income. And this is a widely used index for a lot of different types of loans and fixed income. And for instance, the mortgage rate, whether it's 15-year or 30-year, they're usually based on a 10-year Treasury bond. Okay, so the problem goes as follows. So we want to make an investment with an allocation among these three different vehicles. And we want to, of course, maximize our return. But there are two restrictions. One, we don't want to overweight any of the investments. So the allocation on each has to be between 20 to 50%. And the second one is that we want to hit a risk index, which is 0.12. And the book explains what that means. So we have to come up with that. So those are the two restrictions. And then we want to see what the optimal allocation is. Well, optimal allocation in financial management is a very common problem everywhere. So this is probably one of the easiest, but you'll see that in many different ways. So I think this example is a good start. So to begin, we need to also calculate risks. So let me just start to adding the columns for risks. Before I do that, let me add a row here so that I can label these returns. Okay, and I'll put that in the middle. And now I can copy this whole part to the next three columns. And let me make the column width the same for all of them. So that makes it a little more pleasing to the eye. And then I'm going to have to calculate the risks, right? So The book tells us that the risk is simply calculated as the absolute value of the annual return, which means that when it's positive, then it's the exact number. When it's negative, then it's the actual number. So if you see the return as minus 14, then the absolute value, then the risk is 14%. So to calculate that, the first reaction that I had, or the first instinct that I had, was to do a if function, and then just take that number and then test whether this is positive or not. If it's positive, then I return the number. If it's negative, then I return the the minus sign of that number. But in fact, I didn't know that until now, that there is an absolute function that the Excel has. So that saves a little bit of time. So I'm just going to use the absolute function, and then I'm going to select this one, and then that's all I have. All I have to do. And then I'm going to reformat it and change it to percentages, and then add a couple of decimal places. Now I'm going to copy across so everybody has the same thing. Well, before I do that, let me actually put this in the middle, because when I copy across, when I copy that, then I don't not only copy the formula, but I also copy the format. So I just want to format everything correctly. So now I'm just going to have to copy it down to the end of the table, and then I got all the risks on the annual basis. Okay, so I want to, now I need to calculate the averages, right? It's because that's what we're going to use for calculating a risk factor, and a risk index, and the return for our portfolio. So I want to use the same labels. I'm just going to copy this part. So bear with me a little bit, then you see what I'm doing. I'm going to put it at the bottom, so I'm just going to put all of these here. Okay, so these are just labels. There's nothing else. The reason I want that is because I can see it. I will be better. I will be able to see that better when I move it up and down. Well, some of you may say, well, why don't we just freeze the column? But if we freeze the column, then yeah, you can always see it on top. But if you move up and down, then it may screw up some of the formatting. So I rather just copy those headings for our numbers here. So I'm going to calculate the averages. So the averages are for each column. So I get the S&P return, the average return of the 3-month Treasury bill, average return of the 10-year Treasury bond, and then this one will have the average risk of S&P, and average risk here and average risk there. Okay, so these are pretty easy to calculate. So I'm just going to do the average, okay, and then I'm going to select this whole part. Okay, so I don't know why it comes up as blue, because I probably did some manipulation before, but let me just change it back for now. But I'll show you. I'll do that a little later. Okay, so these are the assumptions that we work off. So we use 11%, 11.84 as the S&P return, 5.05 as a 3-month Treasury bill return, and the 7.9 as a 10-year Treasury bill return. And then the risk for each one is for S&P is 17%, 17.881. So the risk is relatively high. 3-month Treasury bill, you can see why we usually use this as risk-free, because it never goes negative. Well, for those of you who track the market, you've seen negative rate in Europe for the past few years, but I don't think that we have ever had negative rate in this country. So this is treated as the risk-free return. But 10-year Treasury bond is not the same. Sometimes you actually lose money by buying the Treasury bonds. So that's why the risk, in terms of percentage, is shown higher than the return. Okay, so let's let's go ahead and perform our portfolio allocation. So I want to copy these three. I'm just being a little lazy, so I'm going to use these as labels, And then these three cells are going to be the allocation. So each one will be a percentage. Let's see if I put a 0 here, for instance. Oh, they're all percentage already. Okay, let's put a 0 here, and then I am going to make sure that they're all percentages, and then um, they have the two decimal places, and I'm going to put them in the middle. So that will look a little better after I perform the calculation. Okay, so let's do the restrictions, or let's do the constraints for these. So I can add them all up, right? So the one thing that the first simplest constraint is that when I add up all the allocations, they have to be 100%, because I don't want to leave money on the table. So basically, this is just percentages, right? So if I do the sum of these numbers, okay, and this has to be, I put two equal signs so that Excel won't think of this as a calculation or as a formula. It's just a little trick that I use to trick Excel. Okay, so this has to be 100%, right? So that's the first restriction. The second restriction, the second constraint is that, remember, all of these have to be between 50% and 20%. So I want to make sure that all of these are less than 50% and more than 20%. You can do it in any way you want, but this is, for me, this is a little easier just to formulate like this. Okay, so what else do I need to do? Well, I need to do the risks, right? The risk index, or the risk index. So the risk index here is calculated as the weighted risk of all these three investments. So let me delete this one, because it's unsightly. So basically, it's the risk of S&P and the risk of 3-month Treasury bill and the risk of 10-year Treasury bond, all weighted based on the amount, the allocation of the three investments. So I can easily calculate by using a sum product of these three cells and the risk for the three. So I'll come up with this, and this one has to be the same, or has to be 0.12. Again, this is just my way of showing equal sign. Okay, so I want to make sure that the risk index is 0.12, and in fact, because this is a number here, then I want to show, and I want to show two decimal places, so that I can compare that to 0.12. So it's time to put the objective function. So the objective function is the return. It's the expected return. Let's say I'll call it the expected return. That sounds a little more sophisticated, right? So the expected return is basically the weighted index, the weighted averages. No, not average. I'm sorry. The weighted averages of is the weighted average of the return based on the return based on the allocation to each investment vehicle. So this is the weight, and these are the individual returns, and that's all I'm calculating. So I pretty much have everything that I need. So now let's go ahead and do the optimization. So I'm just going to go to data. I'm going to invoke solver. Okay. So now I am actually covering the parts that I want to show. But let's see if I can move this a little bit so that I can. Yeah, let me just show it like this. Okay. So that's a little better, hopefully. So I'm going to solver. Yeah, at least I can see all the numbers. Okay, so what's this objective function? This is the objective function, and I want to maximize it. Okay, sorry. So I actually did all these before, so let me just get rid of that. I apologize because I tried it before. Okay, so so the the objective function is this one, right? And then the changing cells are the decision variables. So these three are the decision variables. Okay, so we have a bunch of constraints. The first one is the sum of all these, this one, has to be equal to 1 or 100%, right? So that's the first one. The second one is that all of these has to be less than or equal to 50%. And then the third one is that all of these have to be larger or equal to 20%. Okay? So what else? The risk index of this whole portfolio has to be exactly 12%. And that's about it. That's all I have. And then I click solve. So the solver will resolve it for me. And I'm going to keep it, say OK. Let me change this to percentage. So that will be nicer looking. And then I'll add this. So my ideal allocation is about 39% of S&P, 20% of the 3 month Treasury bill, and then 41% of the 41.23% of the 10-year Treasury bond. So all of these are met, perfect. So this is what I expect to see. So this is a pretty simple one. So let me just do two quick variations and see if that will change anything. So let's say that the risk index, I'm going to set it not at 0.12%. I'm going to set the risk index to be less than certain risk level that I can accept. So now I'm going to change the if I change the constraint, instead of being exactly equal to, but less than or equal to. So I'll see if it changes anything. So before I do that, I want you to think about what you expect to see. Okay, so I'm going to go to solver, and I'm going to change the this one. So I'm going to delete it. I'm actually going to edit it. Change. So instead of so this is the wrong one actually. Sorry. So it's actually C60. It's this one. Sometimes I'm not finding the right one. So this one I'm going to change it to smaller or equal to. Okay. So now let's see if we get a different optimization. For solve, hey, it's exactly the same thing, right? So there's no change whatsoever. The allocation is the same, the expected return is the same. So why is that? Well, if you think about it, the risk, because the risks are the average absolute value of returns. So the risks are always higher than return in the percentage terms. So if you set the risk to be less than or equal to 12%, then you would expect to get the 12% or 0.12 because you're going to hit the high. Because you're maximizing the return, then in a way you're maximizing the risk also. So if you set the risk to be 0.12 or the risk index, then in order to maximize the return, you will hit the bound. You will hit the top bound. So it doesn't really matter whether this is equal to or less than equal to. The risk index is always a bounded constraint. So let's do another variation. Let's see that if we don't have these two, okay? So we can invest in anything. It doesn't really matter. So let's see if that will change anything. So I'm going to get rid of this one and this one. So basically, all I'm doing is to make sure that I stay below certain risk threshold, and the allocation has to be 100%. That's all. So let's see if we can actually improve it because now we have the freedom of allocating of investing in anything, right? So if we try to solve it and then see how much we improve, well, actually not by a lot. But the investment is interesting because now the it's almost 1/4 of stocks and 3/4 of the treasury bond because we need to hit that risk index. The stock risk the, has is too high. It's is 17.81%. So in order to hit the risk index, we have to, or stay below the risk index in this case, we have to invest almost 3/4 of our money on treasury bond. And there's actually a little bit of improvement on the expected return, which is interesting, but it's really not by much. So even if so, this is another thing that's not a peculiar thing about the portfolio allocation. So it's actually better to try not to overweight on anything. So you can probably improve the overall return just by overweighing, so that you reduce the constraints or reduce the limitations. But the improvement may not be so much to that is worth the additional risk that you introduce to it, right? So there's always the calculation of the risk index, but the reason that you don't want to overweight any investment is because what happened if that investment blows up. So if you overweight in one, then the risk of that one is exaggerated. So that's what you don't want to do. So it's actually just a very simple example like this actually gives us some interesting insight. That is that the risk the risk index is almost always a bounded constraint. And secondly, you may not be able to improve that much just by removing the allocation restrictions.